Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. Thank you for joining me, whether you're here live or whether you're here in the recorded version. Also alongside today is my good friend Cameron May, helping out in the chat out there. 20-plus year veteran of the financial markets, great coach and educator. He's going to be there to help answer your questions along the way. Now, if you're in the recorded version, you can participate in the discussion as well. Leave us some comments in the comment section. And by the way, the other way that you can be a part of the discussion is to follow us on X at Ben Watson CS and at Cameron May CS. And you're going to see all the other coaches there as well. A great way to be a part of the conversation. And the conversation today, I'm sure, will be centered to a certain degree around the fact that it is April 2nd. It is the day after April Fool's Day, and we're sitting here waiting to see, after market close today, what the tariff impacts are going to be. So it may be a day of uncertainty, but at the same time, it may be a day of just waiting to see. Tomorrow may be that impact day, and we'll see if that plays itself out here in the I have a couple of quick housekeeping items. Remember that everything we talk about is simply for illustrative and educational purposes only, not a recommendation of any particular security or strategy. Also remember that equity and index options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of their characteristics and risks of standardized options before considering any option strategy. Now, we're going to be talking specifically about index options in this class, as befits the name. Index options are generally a little bit different than equity options in the fact that they are cash settled. If we have a cash settled index, we'll talk about some of the specific characteristics of those index options. One of the other things that we'll talk about is the difference between European style and American style options. Generally, the index options that we will talk about in this discussion are European style, which means that they cannot be assigned prior to expiration, meaning they don't allow exercise prior to that expiration date. American style short options can be assigned at any time up to expiration. So we'll talk about that and the characteristics, some of the strategies that we will discuss. Also, remember that the paper money platform that we're going to use today, the Thinkorswim desktop software platform, is not a guarantee of future success out there in the real world, but it's a great learning environment. Remember that investing involves risk, including the loss of principal. Also remember that past performance of any security or strategy doesn't guarantee future returns or success. Remember also that when we talk about stop orders, stop limit orders, those can specify the activation price, but not the execution price. And in the event of a stop limit order, there's the possibility that the order gets gapped around and the order does not fill. So we'll talk about that. We're also going to talk a little bit about the idea of hedging today. And I wanted to bring this up specifically while we're talking about this, is that hedging and protective strategies may involve additional costs. They don't assure profit. They don't guarantee against a loss. Neither does diversification, but we'll talk about that in the context of this discussion. So let's jump into our scenario here, and let's talk a little bit about what's going on. We're going to jump over here to the Thinkorswim desktop software platform. And as we do this, I'm going to quickly remind you to click on that subscribe button down there in the bottom right corner of the screen. That's going to keep you connected to the Trader Talks webcast page. The reason that you want to do that is because it's going to make it easier to find our content. It's going to bring that content up to the top of the algorithm, and it's going to bring that content to more people. So that helps us out. It helps you out. It also allows you to set alerts for new content and any archives that are dropped. And it's at no cost to you. So click on that subscribe button along the way. If you happen to like this webcast, click on that like button as well. Taking a look at the S&P 500 today, and this is kind of the broad market, and we'll see what is going on. It has been an interesting week so far, and I know that I say that, somewhat tongue-in-cheek, because interesting oftentimes isn't necessarily a great thing. The old curse, may you live in interesting times, right? And taking a look at what's going on with the SPX today, we see a little bit more bullishness perhaps than many traders were expecting today. And again, that's going back to that discussion, kind of that broad comment that I made at the very beginning, which was today may very well be kind of the wait and see mode the impact coming today once those theoretically reciprocal tariffs are announced or implemented or revised, wherever they may fall, right? And so that's kind of where we are. We're seeing a little bit of kind of price volatility, if you will, if not necessarily implied volatility from the option market perspective. But notice that this candle today kind of engulfing yesterday's trading. I'm going to pop this chart really quickly. We're going to pop down to a shorter time frame, and I'm going to put this on a 5-day, 5-minute chart. And the reason for this is I want to kind of see what has been going on. So the overnight time frames on the index are indicated by those gray bars. We still have the RSI down at the bottom, but you can kind of see what's going on, right? So Monday was a gap down over the weekend, right? As we kind of came to that realization, oh, this is the week, right? It's now the end of the quarter. There was end of the quarter rebalancing. We saw a push to the upside. Then yesterday we saw a move up and then back down into that 50-period moving average and then rallying back up and kind of getting that range established. And now today we see initially gap down. It's Liberation Day, right? The recognition that, hey, it is the day that we're supposedly getting this information. And then we see this rally as the realization sets in that the announcement isn't going to come until the market is closed. So there's perhaps a little bit of rebalancing going on. But overall, what I would argue here on the S&P 500, the broad market, is that the market being forward-looking is looking at the longer game here as opposed to this kind of individual volatility, right? This individual uncertainty, the likelihood of downward movement in the market as a whole. And there's been kind of this positioning, right? That as we go back out, I'm going to zoom back out on our time frame here to our 1-year daily time frame, that this move that we've seen comes as a function of this move to the downside, the 10% correction. Cameron's talked about this in a number of videos. I know he's talked about it on his X feed as well. And so this correction that we saw was, I think, the market kind of unwinding some of those expectations. Now that unwinding is done and getting back to, I think somebody made the comment here, BJ said, double bottom, please. Is the fact that maybe we are establishing that double bottom type of scenario here. We can certainly see that there is a bit of a bullish divergence going on, right? I'm going to take this line. I'm going to remove that line because that was a line that I drew at the beginning of the week, actually at the end of last week. I'm going to redraw this line from this low to yesterday or Monday's low, right? So now we've got a little bit of a declining line. We made slightly lower lows on the SPX at the beginning of the week. Now, notice what's going on with the RSI. We saw two things that happened here that may be an algorithmic push to the upside, right? One is this blip for the first time really in the course of this last 52 weeks, this blip to the downside. That was on this push down, and this was on a strong momentum move to the downside below the oversold line, right? And we saw the RSI, that relative strength index, push below that oversold. But from that point, what we've seen is a push back to the upside and a little bit of an echo of what's going on with price, but for one thing. And that echo is occurring here at a higher low. So if we were to put our circle tool right here and say, okay, there's the other significant point. The fact that if we look at equal points right here on price, we have a slightly lower low on price, slightly, but we have a significantly higher low on the RSI, on the relative strength indicator or relative strength index. And so all this means, and this isn't by no means a guarantee of potential upward movement, but it is a possible precursor to that potential upward movement. Here's the reason why. What this indicator does, and I'll tell you what, if you want to learn more about this particular indicator, several coaches have talked about the RSI. I've talked about the RSI. Cameron May, in his Advanced Charting Techniques webcast on Fridays, has talked significantly about the RSI as a tool to gauge kind of momentum shifts, right? So what this indicator is doing is it's looking at where price is closing relative to the highs and the lows of the candles. So what this is saying, the fact that the RSI is moving higher, is that these candles are getting driven up towards the high, right? Pushing to the high. And that's an indication that there's buying pressure present, not consistently necessarily if we're not seeing price moving, but the fact that we've got a divergence where the RSI is moving higher, but the price is moving lower suggests that buyers are stepping in, right? Okay, buyers are stepping in. Now, a couple of things, and I want to answer a couple of questions going on here in the particular in the chat. And I want to do this with two caveats. One, there's a feedback survey there in the chat, and Cameron's going to put that up on top of the page. He's going to pin it to the top. Do me a favor, fill out that feedback survey. That's going to let us know how you feel about this particular webcast. The second thing is, do me a favor, and I'll help Cameron will help to kind of keep this in line. But as I've asked before in other webcasts and asks, we will ask all day long today, keep the discussion apolitical, simply from the standpoint of let's take a look at what we have objectively as opposed to what we have speculatively or from a political standpoint. So Speak Truth asks the question, the concept of reciprocal tariff, right? Does that mean that the U.S. will charge the same tariff rate that other countries have been charging the USA? That's the theory, right, of a reciprocal tariff, that will simply, it's tit for tat, right? We'll do the same thing that the other countries have been doing to us. And does that equalize things, or does it mean that we shoot another hole in the boat, right? If we think about it from that perspective. So that's ultimately the question. The idea is that these tariffs that we will charge or impose are going to be similar to the tariffs that are imposed by those other countries in importing goods to the U.S. So, that's kind of the idea behind it. And the idea being that, well, if we can't balance the trade scenario and create free trade by eliminating tariffs, we can at least make the playing field level, right? So there's that possibility. So longer term, right, Tanya has, I think, the right idea here. And that is the market's already priced all of this in, already priced in the expectation. And that's where I was saying this contraction that we saw, this kind of correction in the SPX, is perhaps reflective of that. And the reason we're talking about this in this particular class is this sets us up to answer the question that was it? Somebody asked earlier in the chat, how does this impact our index option strategies? So that's kind of where we're going with this, right? Because if we're starting to see some bullish upward movement, and we'll take a look at the NASDAQ, and we're seeing something similar here. Again, a bullish divergence, lower, if we change this line and we make it like that, lower lows, higher lows on the RSI. The one we're not seeing quite as much of a bullish divergence, and I'll even draw this line in here. And maybe we are still seeing a little bit of, I'll activate this line, we'll kind of bring that back down and say equal points here. There we go. We're still seeing a little bit of a bullish divergence here in all three of these indexes, right? So from that standpoint, there is some bullish pressure, right? But notice something. Here on the S&P 500, we're still well below the 200 period moving average, 200 period moving average flattening out, 50 still rolling down. The NASDAQ, the 200 period moving average is flat, the 50 still rolling down. The Russell 2000, the 200 period moving average is flat. The 50 has crossed below. And so this is for some traders what we would refer to as a death cross, right? That death cross oftentimes, however, happens after the damage is done. And we can see that has been working its way out of the Russell 2000 really since that November top. So now, do we see this as a potential bullish indication? Yeah, absolutely, right? So let's do this. I want to pop over here also to our VIX grid, and I want to talk about what's going on in volatility. And I'm going to just zoom in here on the right-hand side. Now, from that standpoint, starting to see this particular movement going on here in the volatility chart. This is the VIX, right? This is a chart of implied volatility on the S&P 500. And again, that broad market, okay? So seeing this move down to this typical average, this is a 30-period average of a 30-period average of volatility, because VIX looks at 30 days of averages in option prices across in the money, at the money, and out of the money SPX options. And we're slightly above average, but who isn't slightly above average, right? If everybody, though, were slightly above average, then nobody would be above average. Anyway, just thought. We're sitting slightly above that average, but implied volatility is not spiking. We're not seeing a significant spike. So we might think, wow, a day like today, which is a discrete event, theoretically, would create a volatility spike. But what we're still seeing is kind of this forward curve of volatility still trending a little bit lower. We see the volatility of volatility being significantly low, right? VIX is lower, or kind of sitting at this average point, but the volatility of VIX, meaning that the market is kind of underpricing, if you will, that potential volatility that's out there. Yes, exactly, Doug. That's exactly where I pulled that from. Everyone is above average. Okay. But the market is kind of underpricing the potential for volatility, which means that those options are still, on a comparative basis, relatively cheap. So what does that mean for us as option traders, right? As index option traders specifically, it means that we could use those index options as a potential to hedge positions and benefit from a spike in implied volatility. Because if these are underpriced, oftentimes this precurses a potential rise. When we see VVIX below, oftentimes that is a precursor to a rise in the VIX. When we see that VVIX crossing below, you can see it happen back here in the May timeframe. You can see that it happens significantly here when VVIX, volatility of VIX, is lower, right? Yeah, I'll share this chart, this index grid chart, real quick. And I'll put this, I think if I haven't already, I'll put this in the description, but I'll go ahead and share this grid. And just a quick reminder that anytime we share anything, any of these grids, it is for illustrative and educational purposes only, number one. And number two, it is not guaranteed as to time or accuracy. So there you got that VVIX grid against the VIX. All right. Now what do we do with all of this, right? Now, this has all been very kind of definitional and expository. But let's go over here to our monitor tab, and I wanted to look at one thing. I wanted to look at the fact that we've got this broad stock portfolio in this particular account, right? Yes, tomorrow is National Burrito Day, Wiley. Absolutely. So here's this broad stock portfolio that I've built in this demonstration account, and it's got kind of a broad cross section of market capitalizations. You can see that I've got some large cap stocks, some very large cap stocks. We've got NVIDIA, we've got Broadcom, we've got Johnson & Johnson in there. So we've got a broad variety of market capitalizations. We've even got some micro caps, right? Lunar and a couple of others. We've got a broad cross section of industry groups, energy, industrials, consumer staples, and consumer discretionaries in there as well. We've also got some information technologies, some communication services, and some utilities in there, right? Some financials, those have been doing fairly well as well. And you can see what I've got in here is a column titled Delta. So that's going to take a look at the positional delta, meaning the sensitivity of each one of these positions to one-to-one movement, right? So the delta of an individual stock share is 1, right? When the price of the stock goes up $1, it gains $1. When it goes down $1, it loses $1, right? And so that's reflective of the position size. So that delta is reflective of the position size. KO, I've got 38 shares, 38 deltas. McDonald's, I've got 200 shares, 200 deltas. Those are each one of their individual unique deltas. But what we want to do is put these into a common delta denominator, okay? So the first thing I did so that you can follow along with this is I clicked on this gear icon right here, and in my column headers for this particular group, I added delta. I just went to lookup column and went delta. Okay, not option delta. We're not looking at option delta. We're looking at delta now, the delta of the position. And so I added that into the list. And now I've got that column showing deltas. Okay. And now what we're going to do is I'm going to scroll up here a little bit right to the top of this position statement line. And I'm going to click on this box that says beta weighting. You can see it right here. It's this beta weighting box right there. And you see right now it says not weighted. Okay. So what we're going to do is we're actually going to weight this this portfolio to a specific relationship. We're going to create a common denominator. So I'm going to click on beta weighting. And the last one that I chose was NDX, the NASDAQ, because I've got kind of a broad cross-section. I would tend to think, however, given the market capitalization size in this group, that the RTY, the Russell 2000, or excuse me, RUT, the RTY is the futures symbol. RUT is likely the closest correlation because of the market capitalization and the position weighting here. So what that does is it converts this delta column into Russell 2000 deltas. So now these are relating to the sensitivity of this portfolio in each one of these positions to the movement of the Russell 2000. So NVIDIA moves to the tune of about 19 Russell 2000 deltas, which means if the Russell 2000 goes up $1, theoretically, this NVIDIA position should go up $19, right? And if Broadcom, or if the Russell 2000 moves up $1, our Broadcom position should go up $33. If the Russell 2000 goes up $1, J&J should actually move in opposition to that a little bit, right? I want to caution you on this. This is all theoretical, right? This is all a theoretical mathematical creation. So what this says is this portfolio is sensitive overall to the tune of about 182 Russell 2000 deltas. So that means that if the Russell 2000 goes up $1, cool, we make about $182 in this portfolio. It generates that many deltas. If, on the other hand, the Russell 2000 goes down $1, we lose about $182. And again, that's that theoretical relationship. I want to make sure you're clear on the idea that this is a theoretical relationship, okay? So now, how do we use this? Let's take this to the next step. How do we use this, especially on a day like today, when there is the potential for, if we go back to that chart, and we go back to our index grid, right? And we look at the Russell 2000, for instance, and we say there's the potential for this to break through that diagonal downtrend line, for this to bounce off that RSI line and start to move higher. We could hedge some of the risk out, but if we hedge all of the risk out of the trade or out of the position or out of our portfolio, we take away that upside potential. So we want to take some of this downside risk off, because if we go back to the portfolio, that is pretty significant downside risk. Our Russell 2000 moves down $1, we lose $182 out of the portfolio, theoretically. So we want to hedge some of this risk off of the portfolio. So here's what we're going to do to hedge some of that risk off of the portfolio in very simple, clean terms. And we're just going to do this relatively quickly. Now, the intent in this particular trade is not to generate returns in the hedge. It is to offset the potential risk. It's not to turn this into a winning hedging position. So this becomes a sunk cost. Now, behaviorally, when we see something as a sunk cost, then we're oftentimes induced because of the disposition effect to say, because it's a sunk cost, well, I've already spent the money, therefore I'm not going to take it off when it doesn't make sense to take it off. And we end up leaving those hedges on for a longer period of time. So be aware of that potential risk, that hedges can be potentially left on for a longer period of time than necessary. So we put the hedge on when we need it. We take the hedge off when we don't, and take that kind of approach to this, as opposed to saying, well, I'm going to resign myself to the fact that this is a sunk cost in the trade. So what I'm going to do is I'm going to go to not the NDX, but to the Russell 2000, RUT. right? We're going to go to the Russell 2000. Now, here's the thing. We're going to look at buying. Now, we've got a couple of other positions here. We've got a long diagonal. This is going to be X that long diagonal. We'll talk about that long diagonal in just a second. What we're going to do is we're going to say, hey, when we have some clarity to this information, maybe it's going to take us a couple of weeks to get some clarity to this perspective of the tariffs. Maybe it's going to take us even longer. In this case, I'm going to go out to 28 days. So I'm going to take 14. I'm going to double that. That's going to put us out 28 days. That's almost a month's worth of time. And the reason that I'm going out 28 days is for no other reason than it does tend to slow down that theta component a little bit if this is going to be a long option, right? We're going a little bit further out in time. So we're going to slow down somewhat the decay of this option. Now, at this particular point, what we can do is we can simply determine how many deltas we want to suck out of that portfolio that would help determine where we're going to position this this long put option to provide a hedge. Okay, so remember, we go back to our monitor tab, we look at our portfolio and say these are beta weighted to the Russell 2000. We've got about 182 long deltas here. We're going to add some short deltas to take some of that out of the equation, right? We're going to take some of that delta out of the equation. So what if we were to say, let's take about 50%, I'm sorry, not even 50%. What if we were to take 50 deltas out of this position or out of this portfolio? And that's going to leave us with what? About 130 deltas or 132 long deltas. It reduces some of the downside risk, but it also leaves us with that possibility of that upside movement. So here's what we're going to do is we're going to go to the trade tab. Now you can determine what position you want to choose and how much of that risk you want to hedge off. So what I'm going to do in this particular case, I'm looking at the Russell 2000, is I'm going to look at buying in this particular case and in the money put option. I want to get to about 50 delta reduction. So look, if I put this trade on, and if I go to the 2040 strike, which is about the 50 delta, but there's that minus sign. That's a reminder. This is taking some of that delta off. This is a reduction in that long delta. If I were to buy this option, right, $57 per share times 100 shares, if I click on confirm and send, the cost on this trade is $5,700, right? $5,700. Here's what I'm going to do before we even do this. I'm going to pop this order, right click, go over to the Analyze tab. I'm going to take my diagonal off, and I'm just going to look at this position, right? And I'm going to say, how much is this delta? I'm going to go hide positions. We're just going to be looking at our position. So here's where we are, 2040 right there. We're reducing our portfolio delta exposure by about 46 deltas. Okay, by about 46 to 50 deltas, depending. That's where we can find it, is right here under price slices in the Analyze tab. So this put option, this long put option benefits if the Russell 2000 goes down. And it can go down all the way to zero, but the likelihood of that happening is almost insignificant. So we're not looking at this being a cash maker or a money maker or income generator. We're looking at this as reducing deltas from a theoretical standpoint. So what we're going to do is we're going to go back to that trade, that order function here. I'm going to go confirm and send, and I'm going to put this in my stocks group so that you can see it. And we're going to read through the order, make sure that that's what we want to do, make sure that we don't have any alerts here. We're not going to put a stop on this. We're not going to manage this from that particular perspective. We're simply going to hold this on and then take it off if it doesn't make any sense anymore. And I'm going to click on send. We'll fire that order off, and we'll see if that order fills for us. If it doesn't, we'll bump it a little bit, and we'll walk it just a little bit to see if we can get it to work for us. So I'm going to go here, cancel, replace. We'll open up that lock because it moved a little bit on us, and there it filled while we were just sitting here waiting. So I didn't need to do that, but it filled for us. Now we're going to go to the monitor tab, and we're going to close up our working orders. And we're going to come down here and we're going to see where's that position. There's our long put option, about a 50-cent delta. And you can see the delta reduction that it created in our portfolio. It reduced our long portfolio deltas by about 50 deltas, 49.83 to be exact in this particular case. So again, remember, this is a theoretical relationship, but that is how, from the standpoint of when that volatility is inexpensive, remember that VIX versus VVIX perspective, this was a relatively inexpensive hedge, even though it cost us $5,000, right? So you got to think about this, right? Now, there are other ways to hedge, right? There are certainly other ways to hedge. Hedging with a short call spread, if you wanted to bring in income, that's going to reduce the portfolio delta and do it at a lower cost, but it's going to have a lower reduction in the risk, right? The other thing we could do is we could use a futures contract. Now, I talk a little bit about this when we come to the futures trading webcast on Tuesday mornings, but that's like using a big giant hammer, big sledgehammer to hedge a little tiny position, right? Because that delta reduction is going to be pretty significant. We may have the risk of over hedging in that particular scenario. And that's something you got to keep in mind, is not over hedging. We could run up the number of positions, the number of contracts here to increase the reduction. If we were to add another contract, we're going to reduce another 50 deltas out of this. So you can kind of tailor or bespoke adjust your hedge to the scenario. Now that we've got that in place, let's talk about a couple of other things. And now that we've got that idea in this discussion, let's talk about a couple of other scenarios here. So this is our long stock portfolio. But what I want to do is I want to come back over here to our index options weekly group, which was, we put on an iron condor because we were sitting right on the line. We were sitting right at last week. We go back to our index here where we were last week. We were sitting right at the 200, right? We could go east, we could go west. It was all up to us. So we put on that iron condor using our index. Where is it? There it is. Our index options grid on the SPX. And we sold one down here. We sold one up here, kind of at that 50, or excuse me, it was about a 15-cent delta, but it was at the 1 standard deviation line. So let's see how we might adjust this. So I'm going to go back to my monitor tab. So we're short the 5,900 call, and we're short the 5615 put. The range, the bracket in which we want the index to stay, is in between 5615. So above 5615, but below 5,900. Where is it right now? It's at 56.55. So it's closer to the put side. So that put side's being threatened a little bit. But that means that our call side is likely going to be trading at significantly less. So you can see what's gone on, right? Our trade price. Let me grab my magic marker really quick. Here's what we paid for our, or what we brought in for our call spread. And here's what we brought in for our put spread, was the net of those two numbers. You notice that our call spread is trading a lot less at the moment than our put spread is. So our put spread's in the process of being threatened because it's gone down, but it's also starting to rally. But the premise of this strategy is that we sell 14 and we buy it back at 7. So we're going to buy this back at 7, and it actually worked a little bit in our favor here. So now we have to make a decision. Do we want to take another iron condor trade, or do we want to be more directional in this particular case? And I'm going to argue that we maybe want to be, since this was kind of our let's see which way it goes trade, now we've seen which way it's going. We're still under the 200 period moving average. Let's be a little more directional in this scenario. So what I'm going to do is I'm going to right click. I'm going to create a closing order, and we're going to buy this back. And we're going to try to buy it back. Let's see if we can buy it back for 390. But we've got a pretty wide bid-ask spread here in this particular case. Not huge, but notice that it's bouncing back and forth a little bit here. So we'll see if we can get it right there. We're going to read through the order, make sure that that's what we want. We'll click on send, and we bought it back for $3.85. So it worked to our favor by about 40 cents. 40 cents is 40 cents, and it adds up. So we hedged both sides, right? We hedged against potential movement one side or the other. But now let's go back to our chart and let's kind of take a look at where this is moving. It's still below the 200-period moving average, which means we're selling call spreads. So let's go out to our trade tab and let's look at where we are. 14 days to go until expiration. That's the 16th of April. Okay. That's the 16th of April. So we're going to go back to our chart. We're going to use our probability of expiring cone. We're going to go out to the 16th of April, and we're going to find that 16th of April intersection here. That's our 14 days to go. And that means we're going to be selling right about just for the sake of this discussion, that's going to be selling right here on the 16th, about 59.11 or so, 59.10. Okay. So we're going to go to the trade tab, and we're going to find that 59.10 call strike. So we've got 100 strikes here on this expiration. We may not get out to the 59.10. We'll see. There we go. So we've got a 59 and we've got a 59.50. I don't want to go out to the 59.50 here. I am going to go to the 5900. Now, one of the things you notice with implied volatility being as low as it is, look at where we are to kind of get to that same delta. This is only about a 10-cent delta. But we're going to sell the 10-cent delta, and instead of having those 10 wide, we've got 50 wide here in this particular case because we're going way out. Now, what that might induce me to do is to come back in just a little bit, right, to the 58.90, come inside that range a little bit so that I've got a narrower spread, because a $50 wide spread, that might be inducing a little bit too much risk in this particular case. But, you know, we could go to a 58.90, which is going to be a $10 wide, or we could go to the 59.50, which is going to be a $50 wide. Let's see what the $50 wide looks like just for the sake of this discussion. It's going to be a little bit wider. So I'm going to go to the 5,900, and we're going to sell the 5,900, and we're going to buy the 5,950, $4 credit. So we're bringing in a little bit more credit here, but we click on confirm and send, and we see that our theoretical maximum loss in this trade is about $4,600. So are we willing to accept that wider loss for a bit more credit, right? And if we still think about this, that's probably about the same perspective as the 10-day, or excuse me, as the 10 wide, just from a risk to reward perspective, right? So, I'm going to go with this. I'm going to go with the 50 wide here in this particular case, but I'd rather kind of stick with where it crosses that probability of expiring cone as opposed to just shifting it around for the width of the spread. So I'm going to put this in my index options weekly, and we're going to bring in a little bit more premium here. And again, the reason why we're selling at 14 and buying back at 7 is to capitalize on a far out of the money time decay curve that accelerates at the beginning, slows down as we get closer to expiration. So we're capitalizing on time decay initially. We're bringing in that credit to begin with. So we're going to send this order off after we've read through it, make sure that we're okay with it. We're going to send that order off, and we sold it for $4. So we'll come back and we'll monitor that trade next week as well. Now, here's the other thing. We're going to go back to our monitor tab, and in addition to that 14.7 that we've done, we've also done a long put diagonal on the Russell 2000. Now, we just bought a long put to hedge against our portfolio. That's hedging off that risk. That's a separate trade. In this particular case, we have a long 2nd of May expiration 290 put that has gone from $54.65 to $83.60. And we've got a short 2020 put, which is currently just out of the money, right? It's gone from, we sold it originally for $11.15, but implied volatility has gone up. The price of the stock's gone up, or the price of the index has gone up a little bit. So it's currently sitting at $23.45. It's become more expensive than what we were paid for it to begin with, which is not what we want to have happen. But nevertheless, implied volatility increased since we put this trade on. That benefited our long option. So this diagonal spread We paid originally $43.50 for it. We can sell it now for $60.25 or 30 cents at this particular point. And so we've made money on this particular trade. I'm inclined at this particular point, given what we looked at here on the chart with the Russell 2000, to say there's some bullishness here in the short term. So I'm going to look at, rather than rolling this diagonal spread out to another short strike, I'm going to look at taking this trade off and capitalizing on the gain that we've made, the almost $20 in gain that we made in this particular trade, right? And then look for another opportunity to enter a long diagonal. But this trade worked in the way that we expected to do. Now, could we roll this? Yes, we could roll that short strike. And in fact, we could perhaps roll that short strike for a little bit more and still gain a credit, because what we've seen happening to those short put options is put options in general have become more expensive. So we could roll out for another little, maybe another circumstance, and gain maybe a little bit more credit on that and make this potential gain a little bit higher. But remember, this is a bearish trade. This is a bearish directional trade, and we're looking at the market potentially being, in the short term, a little bit more bullish. Now, that being said, implied volatility rising is going to help this trade as well. I wish I had added 2 contracts to this, because then I could close one down and I could roll the other one. All right, for the sake of this discussion, and since we have just a minute or two left here, I'm going to roll this short strike simply for the standpoint of keeping this trade going for the possibility of an implied volatility rise, right? Now, implied volatility going up is going to hurt our short leg, but it's going to help that long leg. And if this index goes down, that's going to help this trade as well. So I'm going to go here to this short leg, the 2020 put, and we're just going to roll out for time. I'm going to keep the same level. We're going to roll out for time. So I'm going to right click and I'm going to create a rolling order. And now what I'm going to do is I'm going to be selling, because I'm creating a net position that's still short, meaning I'm buying back the one that I'm currently short and I'm selling another one. That's a net sell. So I'm going to sell this. It ultimately becomes a calendar spread, the order that we're using. And we're going to roll this out to the next expiration, out to the 7th of April. But we're not stuck with the 7th of April. Okay? That's just rolling it to the next available expiration date. We could roll it out even a little bit further. So in this particular case, I'm going to roll out to the let's go out to the next Wednesday. So that's going to be the 16th of April, right? And if we roll it out to the next Wednesday, right, from that expiration, the next time that we're together, then that's going to be a $14 credit. So we're rolling it for a net credit. That's going to offset the cost of that long option. And now, rolling's not a guarantee, number one. Number two, it's not a magic wand. Number three, it depends on the liquidity in the target expiration and strike. So we'll see if this gets filled for us at that strike. But we're thinking about rolling this for a net credit in this particular case and keeping this long option going, this long put diagonal. So we're going to roll this back into our index options group, and we'll see if we can get that 1410 net credit. We might, and again, this is one that might, because we're dealing with some volatility here, and it depends on the liquidity in the target month. You might have to, or trader might have to work this order a little bit. We'll just do that really quick. We'll go cancel, replace. We'll open up that lock, and I'm okay getting 1319. I'm okay, kind of staying somewhere right around that range. Maybe we bring this down a little bit and detune it a bit down to the 1380 mark. Click on confirm and send, read through the order, make sure that it's going in our index options group, and click on send and fire that order off and see if we can roll it. And again, this is one that may, in practical terms, take some time to get that roll to work, especially if there is volatility in the market and it's moving around a little bit, because we're talking about, look, what the market is doing here. So, theoretically, we should be able to fill this, but that becomes, now, if you don't have that particular trade, yeah, you could still, a trader could still put this particular type of trade on. The expectation is moving in a downward direction benefits this trade. So we'll see if that fills. I'll kind of keep an eye on this over the next little while. But here's the thing. We'll just talk a little bit about what we've covered here today. We hedged our portfolio with a long put option on the Russell 2000. We reduced our exposure, and we've managed our Iron Condor. We closed that down and we sold another vertical spread. It's already working in our favor here. And we've tried at this point to manage that diagonal spread by rolling out a little bit, but it's not yet filled. So we're waiting to see if that fills. If you want to find more information about these ideas, pop on over here to the Trader Talks webcast page and to Schwab Coaching. Search here for index options. My thanks to all of you for your participation in this discussion today. My thanks, of course, to Cameron May and to our great production staff for helping out in this discussion today. And we will see you guys again very soon. Take care, everybody. Bye-bye.